In this video, I'm going to talk about the accounting equation, which is a basic tool of accounting. And the equation is assets equals liabilities plus equity. And what I'm going to do is talk about this equation, and I'm going to break it down into pieces so that you can see what every part means. And I'm also going to talk about different transactions and how they affect the equation. This is a basic equation that should always be in balance in the company's books. Every time they have a transaction, after that transaction is entered, the equation should still be in balance. Okay, so first of all, let's talk about assets. Assets are economic resources in the business. A lot of times you can think of this as things they own or property or anything like that. Like a checking account is a resource, it's something they own. A building is a resource, it's something they own. Equipment is a resource. So those are the types of things that would be considered an asset. And they're going to go on the left side of the equation. So cash, checking, savings, investments, buildings, land, vehicles, anything like that would be considered an asset. Office supplies is technically considered an asset because that's a resource for the company. And later we'll talk about the difference between office supplies as an asset and office supplies as an expense. But for now, just know that it's going to fit in this category at the moment. And then some other assets, furniture, receivables are considered an asset. So usually you'll see it called accounts receivable. It's basically just money customers owe to the business. So the company expects to receive that, and that is an asset because that's something that's going to benefit them in the future. So an expanded definition of assets could be economic resources that will benefit the business in the future. So that is just an expanded version that you might see online if you look it up. Let me make sure I didn't miss any examples. And then another thing that you're going to see in later lessons, another asset is something called prepaid expenses. This is when the business pays an expense in advance. So this is going to benefit them in the future when they use that item. And a lot of the examples you'll see in this class and in books is prepaid insurance. If they pay insurance for the year, that's going to benefit them in future months and future, potentially some part of the following year. So that's going to benefit the business in the future and is considered an asset. And then prepaid rent is another example you'll see a lot in your accounting class or your books. And when you pay rent in advance, you have the future benefit of using that space, which is going to benefit the business in the future. So those are just a couple of examples. Office supplies could kind of fit in this category as well because you purchase the office supplies. It's going to be an expense when you use the office supplies, but when you purchase them, it is treated as an asset, sort of like a prepaid expense. And we'll get into all of that later on. But for now, just kind of learn the categories and learn what goes in each category. And then liabilities, those are the debts of the business. So economic obligations. Economic obligations, money they owe to other people, or debts. So for these, you're going to see the word payable in a lot of these account names. Accounts payable, interest payable, salaries payable. taxes payable. Basically, anything that they will have to pay in the future is considered a liability. And another one you might see is notes payable. This is a lot of times a promissory note where they have to pay interest in addition to the principal. And we'll talk about that later on as well. But for now, just know the categories. So these are just some examples that you might see. And something that we're going to talk about in a later unit as well is something called unearned revenue, which it has the word revenue, meaning revenue is usually income. But if they receive money in advance and they haven't performed the service or provided the product to the customer yet, that is technically considered a debt because they owe that service or they owe that product to the customer. And that's considered an unearned revenue, which would go in this category as well. And then another thing that you might see is something called accrued liabilities. So if you see this terminology in your book or online, the word accrued, just think of it as cash hasn't been exchanged yet. They owe the money for this and they're going to pay this liability later. So it's an expense that they haven't paid yet. So we're going to talk about that in later lessons as well. And then the third category is equity, which is the owner's claim to the assets of the business. So you might see it called capital, you might see it called equity, owner investment. There's a lot of different terminology that you might see just depending on whether you're looking in a software, whether you're looking in a book, or whether you're looking online. But it's basically just the equity or the owner's claim. So for example, if this company had $100,000 in assets and they had liabilities of $20,000, that means their equity, the owner's claim to the assets of the business right now is $80,000. In other words, if they were to liquidate right now and have to close the business down and sell everything, the book value of all the items they have would be $100,000 minus the $20,000 that they would have to pay in debt to other people, and that would leave the owner with $80,000 remaining to cash out of the business. Now, it's not going to work like that in real life because market values change. They might not be able to sell everything. There's a lot of variables here, but this is the basic idea. It's the owner's claim to the assets of the business after they pay off their liabilities. So it's just a very general accounting term or concept. Now, for equity, we're going to have two things. We're going to have the owner putting money into the business, which is an owner investment. And then the owner's probably going to take money out of the business, and that is an owner withdrawal or owner draw. So you're going to see both of those things in these lessons, but basically you've got capital investment or owner's investment, which basically is positive equity to the owner, and then owner draws is the opposite. You would be subtracting anything the owner took out. And typically they're taking out cash, but owners can take out assets as well. It's still taking something out of the business, so that would subtract. So within this equity, you're adding investments, subtracting withdrawals. So you're going to see it called owner draws or owner withdrawals. So you'll see it both ways, just depending what you're looking at, but it means the same thing. Owner taking money out of the business or owner taking something out of the business. And then there's also two other types of accounts that are not within these, and that would be your revenues and expenses. And I think I'm out of space here. So revenue is money earned from selling products and services. And this is going to add to equity because any money that business earns is basically a return on the owner's investment. So this is going to add to equity. It's categorized separately and it's on a separate report, but we're going to put it for now within this equity category because it is going to add to equity. And then expenses are costs incurred in operating the business. So these are your day-to-day expenses that they have to pay to run the business. Rent expense, advertising expense, salaries expense to pay employees. And I've got a list. I'm going to actually post this online, but I actually have a list with a bunch of examples. I'm not going to write them all on the board, but things like dues and subscriptions, legal and professional fees, office supplies expense. Those are the office supplies they use up. When they're sitting in the cabinet, it's an asset. When it's used up to operate the business, it's an expense. So office supplies can be an expense as well. Insurance expense, property tax expense, meals, entertainment, travel expense, cost of goods sold is something we're going to see later on. But basically, any cost that they have to pay, utilities, rent, things like that, to operate the business, that's going to be an expense. And expenses subtract from equity. It's taking away from that owner's investment. They have to pay that in order to earn the revenue. So it's going to have the opposite effect. Revenue is added, expenses are subtracted. So you're going to see that as well. And then as far as revenue is concerned, there's a lot of different names for revenue. You might see it called sales revenue. You might see it called service revenue. But companies can have specific names for their business. For example, an attorney might call their income legal fee income. A consulting company might call it consulting income. A magazine company or a newspaper or news company might call it subscription income. So there's just so many variations on the names of revenue. But in the textbook, in classes, usually they stick to a generic sales revenue, service revenue type of account name. But you're going to see it a lot. You're going to see a lot of variations in real life. So now that I've talked about the different account types, I'm going to expand the accounting equation a little bit. Okay, so I'm going to erase these account types, but please check my website, or if you're in my class, check the module online to get this list. Okay, so now that we've expanded a little bit on the equation, we're going to rewrite it. Assets equals liabilities. And for equity, we're going to break that out. We're going to say owner investments minus withdrawals, owner withdrawals, plus revenue minus expenses. So that is going to be the expanded equation for equity. And then just to make sure you have all the definitions, a transaction is a term that you're going to hear me say a lot. And it's basically just an event that happens that affects the company's financial position and can be measured. So it's an event, it affects the financial position, and it can be measured. So anytime a transaction happens, they would record that transaction, and then a later lesson, I'm going to show you how to record things, but for now, we're just looking at how it affects the equation. They would record that transaction, and they would look at how it fits into the equation, and after they recorded it, they would want to make sure this equation still was in balance and still equaled. So that is how it would work. And then you should also know that in accounting, we have something called a double entry system. in order for the accounting equation to be in balance, you have to affect two parts of the equation. In other words, every transaction affects at least two accounts. So for example, if the company purchases an asset, they would be subtracting from one asset, probably cash or checking, and adding to another asset, maybe a building. Maybe they bought a building. So cash and building are both assets, so they're just adding to one, subtracting from another. It only affects one side of the equation. You're just adding and subtracting from the same side of the equation. Or if you have a situation where, for example, the owner invests some cash into the business to get it started, that's going to add to cash and add to the owner investment account. So you're adding on one side of the equation and adding on another side of the equation. So that's how it's going to work. Every time there's a transaction, it's going to affect at least two things. It would be recorded, and then after it's recorded, the equation would need to be in balance. And we're going to practice this. It's too hard to do it on the board because you can't really see the examples I'm going to use, but it is something that I'm going to make a separate video on my computer about, with an example where we go through an equation and I show you how each transaction affects that equation. And then one other thing that I want to say, just to kind of prepare you for a future lesson, is that when we're looking at revenues and expenses, we're going to look at the profit of the business. The profit of the business goes back to the owner as a return on the owner's investment. So another thing that you should know at this point is that we're going to look at net income and net loss of a company. So net income. So first of all, we're going to look at revenues, which is money they earned from selling their products and services, minus expenses. Well, the difference between money they earned and the cost of earning that money is either a positive or a negative number. If it's a positive number, that's a profit, that's net income. That means their revenues were more than their expenses. If it's a net loss, if it's a negative, it's a net loss, that means their expenses were more than their revenues and they lost money. So we're going to look at this further in later lessons, but for now, you should know that this is going to be something that we're going to look at. And also know the accounting equation and the different account types. And I encourage you to get my list and review that and make sure you're understanding it. And one thing that I want to mention also, sometimes people get confused on whether something is an asset versus whether something is an expense. Assets are more of things they're going to possibly use in the future, things that are a resource, whereas expenses a lot of times are things they've already used up or they're using up in the current period. For example, rent. If they're paying it in advance, it's a prepaid rent situation where it's going to help them in future months. But if they're paying for the current month's rent or past rent for prior months, they're already using that rental space. So that's more of an expense. It's more of a cost of operating the business. So that can lead to a little bit of confusion. But at this point, I wouldn't worry too much about that. But I just wanted to point that out, that can lead to some confusion. But other than that, I'm going to go ahead and stop this recording and move on to the next lesson in the next video. Thank you so much for watching.